Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about the XLF. That is the ETF that tracks the financial sector. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest. On Monday's Stock Play of the Day, we looked at the XLF. That is an ETF that tracks the financial sector. We talked about buying and a deep in the money call option as a substitute for buying the stock outright. And as you see here in the Ally Invest Options Playbook, that strategy is actually highlighted in the rookies corner of the playbook, called buying a leaps call as a stock substitute. Now, leaps is just a fancy name. It's just long-term equity anticipation security. All that means is that these option contracts usually have longer dates. Now, we only went out 90 days in time. And honestly, today's stock play of the day is going to be a little bit boring in that the stock really hasn't moved very much. Now, the markets have been very volatile this week. We saw it down most of the week, and today we see it back up again. So that volatility that we've been talking about, that the VIX index, the volatility index, has been highlighting, has actually been there. So the volatility is starting to kick in. We are in October, which is traditionally a very volatile month for the marketplace overall, but we're seeing it. So today, if we go back and we look at the chart from Monday, and here we have it, that, one second here, let me get my screen all set up. If we look at it, we see that this is a 15-minute chart. These bars are 15 minutes long. So I've highlighted on Monday when we taped the stock play of the day, it's noon on Mondays Eastern time. This is where the underlying stock was at. And that was right around 25. I think my notes say 25.41 when we looked at buying our long call option. And the stock did make a little bit of a run up, but now these are only dime increments over here on the right-hand side. So the stock is down about 40 cents at this point in time. Right now, this is a live quote. It's trading right around $25, almost exactly. So the market ran up a little bit. Now it's came down a little bit, and then it's actually ran a little bit back up. But overall, the market is fairly flat to where since we actually talked about this underlying stock. So what can we do with our position? Well, a lot of people would just stay the course in this instance. But what we looked at doing on Monday was a 91, well, on Monday it would have been a 96-day to expiration option contract, goes all the way out to January 15th, 2021. We went a little bit into money. We bought the 22 strike call option. The implied volatility is around 30%, which is high relative to before the pandemic and everything else that was happening, but it did have an 80 delta. So what has happened, the stock has gone down about 40 cents since Monday overall. And we see this position when we were looking to place that trade, we were trying to pay $3.80. That meant our entire risk profile based on that one option contract would have been $380. So we really just stay the course. We're down a fraction of what we paid for it on a percentage basis. We're down a little bit, but this was more of a long-term outlook on the XLF and the financial sector in general. That's a lot what Lindsay Bell, my colleague, talked about on a fundamental basis. So we'll go and we'll look at the trade. This is the option contract that we were looking at. If we were to do anything, and we did talk about this strategy on Monday's call, we talked about a covered call position on owning 100 shares of stock. So instead of buying the option contract, you might have bought 100 shares and maybe sold a call against it. We don't get a ton of premium for these call options. We have decent volatility as far as the implied volatility for the option contract is concerned. But the fact that it's a low priced underlying trading around $25 takes away quite a bit of premium in those option contracts. But an alternative strategy that I would consider doing, but I'd probably do it after the earnings season, is actually sell a call against that position. And that would actually be called a fig leaf. Now I'm highlighting that in the options playbook right now. But a fig leaf just basically means I have a long-term option that I bought as a substitute for the stock, and I'm going to sell a shorter term option to get it against it, effectively creating something that looks like a covered call position. So in over here on the right rail here, we see it says buying in the money leaps option. It talks a little bit about buying an 80 delta option contract. That's the more important thing because you want something that acts a lot like the underlying stock. An 80 delta implies that this would act like approximately 80 shares of stock for each option contract that we bought. Now, on a lot, as far as the price is concerned, it's going to be a lot cheaper than buying that stock outright. But that is the concept of buying an 80 delta option contract. And then we're going to sell a out of the money short-term call option against it. So eventually something that you might do as a hedge or to try to lower the cost even more than buying this option outright is to look at, in this instance, I'm just going to look at a 21-day option contract. And this is what I'm kind of talking about the premium. If we look at the 26 strike calls going out 21 days, that would be the November 6th expiration. Right now, you could sell that and you could bring in about 32 cents, maybe 33. The markets are really good in the XLF, and that is a good thing overall. So I would consider after earnings, maybe selling a call against this position, trying to bring in some time premium to offset the time premium that we paid for the longer term option. But in general, the thought would be that you would just stay the course here. Now, as always on this stock play of the day and stock play of the day overtime, this isn't meant to be a recommendation. We're just trying to learn. And this is a possible scenario that you could go through now that you have that position on. So that's going to be it for this edition of the stock play of the day. Don't forget to click subscribe and ring the bell, and we'll see you this Monday at noon Eastern time on the Ally YouTube channel. Thanks for coming.